So this is a scene-setting panel. We're going to try and hit some of the main themes of the day. And Audrey, if I could come to you first. Sure. I think you were here last year at the event. Just take us through the big trends that you've seen over the past 12 months. What's changed?
Yeah. So, well, look, I think as as you and Andrew said earlier, I think frankly the fact that The Economist is doing a conference on impact investing last year was a real sign that this was mainstream in an emerging way. I think what we've seen over the last 12 months is really just a continued growth and acceleration in the space. And I think you can, I would say there's a couple of trends. I would say one is just the really roaring increase of interest across both individual and institutional investors. Actually in a survey that we did last year, we saw that 75% of active individual investors said that they were interested in sustainable investing, led, of course, by 86% of the millennials. But more than just sort of frothy talk about being interested in it, because, of course, people say they're interested in things that sound nice, we've actually seen real asset flow. So in the United States, it's now more than $9 trillion. So more than 1 out of every $5 under professional management in the United States has some sort of sustainable mandate on it. And globally, it's more than 1 out of every $4. So you're seeing really large, serious assets shifting into this space. And I think what that reflects is, look, you don't have that kind of serious money moving without actually an increased sophistication in the space. So I think compared to 1, 2, 3 years ago, the amount of sophistication in the space from the questions the investors are asking, the returns that they're demanding, and what asset managers are putting into this in terms of rigorous financial due diligence and analytics is really becoming a very significant virtuous cycle.
And that figure, the 1 in $5, that's the most generous interpretation of kind of what we're talking about here, right? So that's all ESG, ethical investing.
Yeah, those are the numbers from US SIF, and those are broad, right? Those are everything from some sort of restriction screening, some sort of ESG filter, or potentially also very intentional, very specific thematic investing.
Right. Okay. Does the Think letter matter, do you think, in all of this? Is that another signal, or is that a smokescreen?
Absolutely. No, I think that it does matter. It shows you that, look, when you have some of the largest asset managers and also some of the largest asset owners in the world, right? So the largest pension fund in the world has recently declared that they're going to have ESG as part of their stewardship principles, and they're going to put, for now, 10% of their equity only into ESG qualifying funds. You're seeing serious capital going to into that direction, and I think Think's letter absolutely signals that, look, we're in a new day. This is not about soft-headed, emotional, tree-hugging, whale-saving, emotional investing, right? This is about how do we know that in this world where, look, we probably have in this room, conservatively, the computing power of, I'm going to say, 350 supercomputers, or what was called supercomputers when I used to work in government. That means you have an unprecedented amount of transparency, of data, and desire to query that data. In that kind of a world, how can you ignore things that could actually be material to the value of your company, material to the value of your investments? And so I think this is not a door that gets closed.
Richard, can I come to you? I think you accept the premise that impact is growing, but it worries you.
Okay. Actually, I'm not so sure I accept the premise. I accept the premise that there are large numbers, but I believe that impact investing and the field, the language is often too loose to allow for disciplined measurement. I think it's one of your polling questions to see how other people feel about it. I'll take an example from about the growth in my own life. Maybe it's not an example I should tell, but here I go. My firm, we manage $4.2 billion, invest in transactions with European banks that share the risk of the loans that they originate to their investors and pass that on to institutional investors in our funds. We have an ESG policy. We have to have one. We have Northern European investors. They expect to see it. I'll confess, what we did in our ESG policy is we looked at what we did. We drew a target around it, and lo and behold, we hit the bullseye. We agreed that we're not promoting child labor, we're not investing in consumer firearms, we're not bribing foreign dictators, which we weren't doing anyway. and now we count in the ESG. So I don't know how much of that 9 trillion are people like us. My responsibility is to look after the retirement funds of firefighters and teachers, and I pursue my mandate from the investors, which is to not to engage in financial concessions in order to pursue my own ideas about what the world might need, which I would gather probably coincides with everybody in this room. It's just a question of how we get there.
So too woolly is the charge, or at least it's possible to define things in ways that are too woolly.
Yeah, and look, as an economist, when I hear about impact investing, I want to know what market failure does it address. And we have 3 forces to contend with: capitalism, philanthropy, and government. Take one example, monopolies. Everybody here agrees monopolies are a bad thing. They produce too little, they charge too much, they co-opt regulation. Do we deal with monopolies by divesting shares of companies that engage in these practices? Do we direct our capital to competitors of monopolies that will behave in a more competitive fashion? Of course not. Government breaks them up. Government regulates them. We go one by one: provision of public goods, the dealing of externalities, the asymmetric information, agency problems. There are, and I look at those 3 forces that have lifted billions of people from poverty in my lifetime. I want to know theoretically and empirically what argument is there that there's this 4th thing. And I look at these, if I could just look at the scholarly literature. In the top 7 economics journals, the term impact investing has been mentioned exactly 0 times in my study of this. Socially responsible investing in the history of these journals has been mentioned 10 times. So I'm still in the market for a theory about why combining philanthropy with investment is better than keeping them separate. And I don't want to take up all the time, but I could raise issues why I think it might even be dangerous.
Okay, well, let's come back to that thought. Perhaps, Jim, I don't know if you can theorize on the fly, but to that challenge that philanthropy, government, and capitalism is enough, why do you need this 4th element? How would you respond?
Well, I liked your term impact gospel. I mean, I thought that was really great. And I'm probably more on the evangelist side than on the naysayer side. But I believe that we live in a world where there are a lot of problems. There are a lot of challenges to face. And when you look at the Sustainable Development Goals, it's been estimated that there's, I think, about $7-8 trillion a year that you'd have to be able to have access to address those. I mean, these are really big challenges. You look at organized philanthropy and what it contributes towards the solving of those, and it's but a drop in the bucket. It's estimated at about $60 billion. And you look at what governments and other stakeholders invest, and it's just not enough. Frankly, in order to really move the needle, you've got to engage private capital, and that's really what impact investing does. And I guess I differ a little bit with Richard in that I come at this really as an entrepreneur, with a business that had to make a major pivot at a time of real economic challenge. This was during the dot-com bubble burst back in the early 2000s, and we focused on a very underserved market, and we had a tremendous success financially. But more importantly, I think we were able to accomplish things in terms of solving a problem for this underserved community that would not have been done by philanthropy or accomplished in that way or by government. And for me, it set me on this path for looking for other opportunities and how to build upon this. Impact investing is relatively new. I don't think you're going to see it in the same kind of light that you will other terms in magazines and so forth, because it is a relatively new and emerging field. But I think there are a lot of reasons to be optimistic at this point in time. And one of them for me was an experience just yesterday. I've been involved in some legislation that I think is really quite groundbreaking, because it really does, I think, embody impact investing in the movement that's moving forward. And it was a very bipartisan piece of legislation called the Investment in Opportunity Act that was included in the tax reform legislation that was passed this year. And to be there in the White House, and the White House has really gotten behind this, and to see the bipartisan support from both Republicans, Democrats around the table, focusing on this new legislation, to me it was a great indicator of the momentum and how this new concept of investing in improving and benefiting society is really catching on and moving really into major policy.
And Andrew, can I just jump in on this, because I think there's especially since this is sort of a scene setter, I think there are a couple of incredibly important things to make sure that we have the frame right on, right? Which is, frankly, no one that I talk to, none of our investors, none of our approach is ever saying that private sector capital should be there instead of philanthropy or government work or any other efforts there. No one is ever saying that private sector capital can or should or would ever want to do those things better, right? There are, philanthropy, exactly as Jim said, is an incredibly critical and precious resource that we don't have infinite amounts of. And I know Deb Schwartz is somewhere in here, and she'll talk to you more about the critical catalytic role that inspired philanthropy can play to come into things where no other capital would. But if it's done the right way, it doesn't have to be there by itself, and it can unleash and create the conditions, whether it's through a first loss layer, whether it's through other de-risking things, whether it's through capacity building, to create those conditions for capital. And similarly, government policy is a critical thing. I mean, look, if nothing else, private sector investment capital is logical. It will follow incentives. It will shy away from disincentives. And so public policy plays a critical role in shaping the direction of which issues do we believe are important as a nation, which issues does the government choose to incentivize private sector capital come in. But then it appropriately, both philanthropy and private sector leave it to the capital markets to scale. Right, as Jim said, philanthropy is about $60 billion a year that can be put to work. Non-defense federal spending is maybe roughly $3 trillion, and the U.S. capital markets is around $40 trillion in terms of just the assets under professional management. So why would I think the question is sort of I would hope that we don't have to spend a lot of time saying why would you do it. It's more, why would you not? It's sort of saying, if you want to be healthy, why would you spend all day debating, should I exercise or eat right or take medications, right? This is like, of course you should do all three. And then I think what the real issue is for people who are sophisticated investment and economist professionals as you are, is where do you find the quality, right? And I think it's absolutely true. As the interest has grown over the past couple of years, everyone has sort of rushed to say, oh, sure, I'm ESG too. I can tick the box too. And so you're exactly right, a lot of the proliferation of funds now categorized as ESG is people who're saying, sure, we didn't practice it anyway, so now we can say that we're doing it, right? But that's actually not what most of the conversations that we're having. And because there are now many more choices, there's actually the ability for investors, and we're seeing these sophisticated investors actually saying, yeah, I'm way beyond box checking. I'm interested in specifically, for example, a proactive climate change tilt, and I want to understand what you're doing there. I want to look at what you're doing. And then lastly, the reason, frankly, that so much of what we're focusing on looks at ESG is because we actually believe it can actually give you better, more complete information about risks to your business or opportunities for your business. Our equity research team, we have a sustainability team within equity research. They are not woolly-headed, they are not tree huggers, they're looking for beta reduction and alpha creation. They have gone through and worked with the 30 different sector analysts to say, for automotive, for transport, for information services, for consumer, what are the discrete number of factors that are currently labeled as quote-unquote non-financial because they're not in your financial statement, and which of those could actually have material financial effect, right? There's an organization, the Sustainable Accounting Standards Board, that has specifically gone through and defined materiality standards for each industry, and these are things that increasingly equity analysts and investors are saying, if I'm blinkering my view of this company and not looking at something that might have a material impact on their earnings just because it's environmental or it's social and it might be woolly and hard to measure. They're saying you actually can measure it and it actually has material impact on your valuation, and our equity analysts are using those to make upgrades and downgrades.
Okay, let me bring in Richard.
Yeah.
So two sort of challenges there. One is that ESG has material impact on performance, and the other is kind of why wouldn't you do this, right?
Okay, why wouldn't you do this? That's a very good question. First, before I answer it, I address it, let me just say, everybody in this room, including me, wants the same things. We want gender equality, we want reduction in poverty, a healthy environment. I think one can question this without taking the pose of, what's that philosophy of Ayn Rand where you only care about yourself and you're a weakling unless you do? It has some name. I don't know what it is. Was it? I don't know what it's called, but you don't have to be that. I think that one can have, the same desires and concerns for the well-being of others, and still question whether this is the best way to execute that. And I think, and nor would I ever want to take the pose. I don't know the details of Jim's career, but from what I know of it, there's, it's something to be admired and made a marvelous contribution to public good, and without always thinking, how am I going to make the most money in the shortest period of time? And I would never argue that a rational person ought to adopt that awful point of view. But what I think is dangerous about it is, one, it confuses the governance of investors and of managers of companies who now have a single objective to try to aggregate the interests of a broad constituency who have different views, poses a potentially insolvable problem. One problem that is solvable is aligning your investments with your own ideals. That's easy. The question, can you create value through investing, or to somehow to do good without making a sacrifice of resources that could be allocated in some other way? I think that's a much more difficult and perhaps an impossible question. One other thing I think that is potentially dangerous about this is I think it confuses it confuses young people when you use expressions about directing capital to do good. Whatever your politics, whatever your economics, regular capital does plenty of good. Nobody can dispute that. When I have my students come to me and they think, can I be a good person unless I go to do this type of work? And I have to tell them, no, everybody has a contribution to make, and you don't have to. You can go in a direction that feels meaningful and useful to you, and you shouldn't let people tell you that isn't good or useful. If you're obeying the law and you're being productive and you're not idle and you're honest, then you're free to do as you like. And the messages that are coming at them, and the same issue with my own children, is that they should feel free to be an entrepreneur, or to go work for a charity. It's up to them.
So we're in wild agreement on that, right? I mean, we absolutely, actually, I appreciate your being a great brand diplomat for us, because our brand slogan is actually capital creates change. We absolutely believe that capital is oxygen that is needed for great entrepreneurs like Jim and the entrepreneurs that have actually built our entire economy. So we absolutely totally believe that capital creates change. I think what we think is the most interesting thing for people to think about is exactly as you said. We would never want someone to be confused about their economic or financial goals as a result of it, right? One thing that we always say is, look, just because you put the word sustainability into an investment statement does not mean that it will magically levitate. It also doesn't mean that it will magically underperform. It actually means that the laws of physics still apply. The laws of fundamental good investing still apply. And if you plot the performance of traditional funds, you'll see this. If you plot the performance of sustainable funds, you'll see this. Right? These are both bell curves, which means you can underperform or outperform, either way, and that manager selection and rigorous financial analysis and rigorous clarity about what is the result you're seeking is what is important.
Jim, can I bring you in on the sort of, if it's not social finance, it must be anti-social finance point, which Richard, I think, is making. There's a demonization risk.
Yeah, I'd like to comment on the next generation because at the Sorensen Impact Center, we work with a lot of students, and we don't find that students are trying to question whether or not they should be doing something. I mean, they have a very specific mindset that the next generation wants to be involved in utilizing their education, utilizing their experience, and making decisions that help to improve the world. I mean, that's more their mindset than it is, the legacy generations. And they're coming and wanting to be involved in what we're doing. We have more applications than we can accommodate, and benefiting and finding really great opportunities in their careers as a result of the time and effort that they put into this is a choice. And about 75% of this group of millennials and X-Gens look at investment decisions in terms of how they benefit society. It's in their mindset. So I don't think it's a confusion. In my experience, it's really an automatic disposition of this of the newer generations, and I think that is going to be a big factor in driving impact investing into the future. As I meet and I work with this next generation, the energy that they have, the excitement, the optimism, and really the desire to be able to utilize who they are and what they develop and learn for good is a common theme. And I think that's another thing that really gives me reason for optimism.
Can I do something? I'll come back to you in a second, Richard. Can I do something very unfair and ask Amit, who's going to come up to the stage in a few minutes? Can we get a microphone? Because to Amit Buri, are you already wired up? I think you can be switched on remotely in some way.
I think I am.
Yeah, there you go. Perfect. So this idea of a confusion of objectives is, which Richard talks about, right? That the idea of holding both financial and social objective in your head at the same time as you run a company is inherently confusing. For those who can't see, it's Amit Buri from the gin.
Hello.
I'm sure you get asked this a lot. What's your response?
Well, I do think it's absolutely accurate to say that it does challenge the way that business has been done in the past, and I do think it's much more complicating to think. But I also think that this is the future of how we need to think about investing and managing business. Is a much more integrated perspective. I'm thinking not just about the financial performance, but also the effect and the risks posed by social and environmental factors. So I completely think that and agree with the fact that it is more complicated. I do think it is challenging a lot of ways that things were done in the past. And I do think it is a huge deviation from the status quo. But I also do think it's important and essential for us to be successful in the future.
Richard, do you want to come back?
Yeah, I would actually. I'm not ready to take on the role of brand diplomat yet because
We'll get there eventually.
I'm not. Well, we'll see. I'll tell you what it would take to get me there. Okay. First, there is a bell curve, as you say, for traditional investments and for investments that self-identify as sustainable. One is here, the other is here. And you subject that to old-fashioned rigorous statistics, and the result comes up again and again. There is return that is sacrificed. There is not a free lunch from this. I've replicated one influential study and found the opposite conclusions. It's in an online journal that I wrote with Martin Sattel. You can easily find it. It's not a lot that one sacrifices, but it's there, and it's statistically significant. So resources don't come from like magic from nowhere. So I think that's one of the so I think it would be lovely if we could do all these things and not have a financial concession. Then we don't have to worry about aggregating the views of our constituents because they want to make more money. This makes more money. Unfortunately, I have seen no evidence for it. And again, to the extent that there are scholarly studies, they find the same thing again and again. It's just a fact. I wish it were otherwise, but I have seen nothing that overturns that view.
Audrey, do you want to come in on that? We have a panel on exactly this. Risk and return later, so we can prefigure some of that.
Look, I think that everyone has different data that they look at. If you look at the most recent data from very credible organizations like Harvard, like Oxford, like MSCI, even just since 2015, which is, I believe, the period that your paper looked at, Richard, there have been more than 20 papers out of places like Harvard, MSCI, and Morningstar that show that if you do it right, can have positive correlation between ESG and returns, right? We did a paper that Richard was referring to. The point of our paper was never to show that, as I said, that sustainable strategies consistently, always, in all cases, outperform. That's not the point, right? The point is that we really have seen that that you do not have to suffer a penalty. And in fact, again, when companies are making thoughtful decisions about how environmental issues or social issues affect their business and integrating those, that it really can create value. I would actually point you to a recent Harvard study that, actually there's several recent Harvard studies since the time of the Richard study, one which shows that if actually you'd taken a portfolio of company 20 years ago, put a single dollar into it and just sort of let it run, and that was companies that sort of go by all the sort of normal traditional methods, that $1 would have grown to, I believe it was $14.36. Maybe it was 86 cents. If you had taken that, $14.46, sorry. If you had taken that same portfolio of that same dollar 20 years ago and put it in companies that were actually looking to materially relevant environmental and social governance factors, that $14.46 would have grown to $28.36. There's another more recent Harvard study that I think is actually very interesting, which shows that, I think, to one of the points you made earlier, Richard, there are sustainability issues that matter to business, and there are sustainability issues that may not for your business. And the Harvard study is very sophisticated. It actually looks at comparing companies that focused on the sustainability issues that matter to their business versus the ones that are more window dressing. And lo and behold, if you focus on things that are material to your business, if, for example, you're a manufacturing company and you have high intensive usage of water and energy and other things, and you focus on managing those well, those will do well. If you focus on things like putting pretty pictures of smiling kids on posters that make you look nice, those probably aren't value creating. So there's absolutely ways that you could say you're doing ESG and end up suffering a return. And there's absolutely ways that you can be thinking about environmental and social factors, whether or not you label yourself ESG. Right? We're much less concerned with whether you label yourself an impact investor or sustainability investor, and more about the results. We actually did a very in-depth study around gender equity, and I know we've got some folks in the audience who've really been in the leaders of that. And when you look not just at something on the surface, like are there women on the board? That's one important one, but you look at a whole host of factors around, is this a company that is really looking at a diverse and inclusive work ethic so that they benefit from the diversity thought to lead them to have things? What you see is they actually had, from a stock price performance perspective, lower volatility, higher ROE, and all sorts of other, and they actually also had a modest outperformance in stock price. So it really gets down to, again, I think where you started and, is exactly right. You can be far too woolly about almost any definition. And the whole point of why you have conferences like this is to make sure that we all help each other get smarter and to not be woolly about the definitions. And I think Jim is, what I sort of consider the Sorensen spectrum of the ecosystem that Jim has been acting on is a really great model, right? I mean, Jim has things that are purely philanthropic and doing those incredibly precious, valuable things that only philanthropy can do. He has things that are purely profitable, that maximize profit in ethical, legal, and wonderful ways, right? That there's creating positive change. And he has some things in the middle, because there are places where you gotta get the whole table together, and you gotta have private sector and public sector and nonprofit practitioners to work together. And that's where having the definition and having clarity about where are the cell membranes between the different portions of this is where you get unwoolly and you get productive.
Okay, so and we may come back to a lot of this in second sessions. I want to give everyone here a chance to throw questions. One has come in from the app, so it does work. Do you think impact investing can correct the inefficiency of charitable giving? So not so much capitalism, but charitable giving. Jim, do you want to have a bash at that one?
Well, sure. I think that there's a great opportunity for foundations and charitable giving to work with private capital and take a very catalytic role in helping to leverage and focus, on solving, problems like poverty and other issues around the world. I think there's always going to be an important need for grant funding out there for, helping to, in the very early stages, be able to get something to a point where, it can, be able to become more scalable in a more self-sustaining way by bringing in outside private capital. So it's really, I think, a very important combination of both, grant funding as well as more programmatic program-related investing that can enable charities and foundations to really develop a much more sustainable path.
Thank you, David Nage. I run a family office. I've been an impact sustainable investor for 10 years, and I hate the phrase impact. I think there are 10,000 family offices in the world, and I suffer every day trying to get them more on board for this. Are we at a point right now, and I think about sub 5% of that 10,000 actually make these types of investments, from my knowledge. At what point do we actually say, okay, it's time to throw the word impact out and rebrand to something that is more encumbering and brings more people into the fray, so we have more capital and more access to capital for the founders of businesses that are trying to change the way that we're running our world right now?
Audrey, do you want to take that? Is it time to throw impact out, just as we've jumped onto this?
Exactly.
Sure.
I'm getting a few more and a few textbooks first.
Well, it's shocking the number of college courses that are focusing on it. But look, I think that we have a lot of terms floating in this space, right? And I think that is one of the points. We've got a lot of terms, we've got a lot of confusion between socially responsible investing, ESG investing, impact investing, sustainable investing, investing with impact, Right, exactly. I mean, that's frankly the direction that we are going in, which is, look, every investor is different, exactly as you said, right? Every investor has different goals, different time horizons, different risk tolerances, and different issues that they may or may not care about. And we're not trying to dictate to anyone what those should be. I think what the field needs is more clarity, so that, and we've tried to do a little bit of organizing, saying, if there are just things that you as an investor cannot sleep at night, if you know that your portfolio is in any way invested in, then there's ways to do screening. And the ways to do screening have gotten much more sophisticated than they were, so they, do not have to come at all times with a performance detriment. If you say, I really believe that ESG is actually you know what? It's a good proxy for good management, right? If you're doing all these right things, you're not doing things that are illegal, you're not doing things that are going to get, reduce your public license to operate. So there's ESG funds. There's things that are saying, you know what? When you just look at the demographic trends, we're 7+ billion person planet going to 9+ billion people. There is going to be an increased need for housing, for education, for healthcare, for all sorts of things. Those are going to be growth sectors. Which are the countries that are growing the most? I want to invest in some country that has an outsized growth rate for the middle class, and therefore will have an outsized need for quality. You can do that. Or if you want to do what seems to be most often referred to under impact investing, right? That's a service that many people interpret that as a separate subset, where you're really saying, I want to apply my capital to something that will specifically change educational outcomes at the 6th grade level in the upper Midwest of North America. You can find ways to do that. It is harder. It may well, to Helen's point, be a smaller target that may not be readily scalable. And I think that your question is great, because specifically what we're saying is when we talk about the $23 trillion, right? It's not $23 trillion going to improve 6th grade reading levels in upper Midwest and North America. It never should be. But it may be the whole spectrum of opportunity. So I think, I don't know the way I would throw the term away, but I might say we need to be more specific and thoughtful about which term we're applying when.
If a family office wants to improve 6th grade reading levels in the upper Northwest, that is completely up to them. They made their money fair and square. If they want to express their will and make their own investment, I've got nothing to say about it. And is it possible that rather than investing in a company, a money-losing company or a barely profitable company that engages in this activity, that subsidizing for-profit companies might be better? I don't know. That's, again, an empirical question.
Well, hopefully you would never advise him to invest in a money-losing operation.
Well, no, look, if he's got some other goal besides maximize, they've already have enough money and they have certain things they want to achieve, such as improving reading levels, who is anyone to say that they're not entitled to do that?
And most investors would do that
We're
out
going
of
to
the
go
pocket
to
of
the
the money
next
that is
question.
dedicated
Okay,
with that.
you have the microphone there.
I agree that impact investing covers too many different types of investing, but I think a fundamental issue here is who's the investor. If it's yourself, you can do anything you want to do.
Exactly.
If you're a charity, then you actually do want to take high risk, low return, or even maybe a possible loss if it's a program-related investment. But the critical issue is, what if you're investing as a fiduciary on behalf of a pension fund or a private trust? And there you have to be prudent, and that's where these studies that you have been talking about are important, because a fiduciary is going to be liable if they act imprudently, and if they can take ESG factors into account without sacrificing return, it's consistent with their fiduciary duty and vice versa. One question I have is, in these studies, to what extent is the cost of complying with government regulation factored into whether ESG has an impact long-term on companies? Take, for instance, chemical companies that polluted water and then suffered penalties and moved their operations to a less regulatory intense environment like China. If the government didn't care about pollution, the company would not have suffered those costs. So how does government regulation impact these studies about return on ESG type investments?
Does anyone want to take that?
I think, let me give one example. I'll give an anecdote from my personal life. In my business, we invested in, we built out wind farms in Germany and France in 2005, 2006. We financed them through securitization. After that, we've insured loans of banks in Germany to fund these wind farms. It's all been profitable because the government guarantees a feed-in tariff of 8.5 cents per kilowatt hour for everything we can produce. It's a very clear subsidy, and if you've been to Germany and driven through, there are wind farms everywhere. And it's all been private capital trying to make money based on government subsidies. And I think an investor taking matters into, we never took matters into our own hands. We never represented ourselves as, they didn't have impact investing when we started this. So we said, we're not socially responsible. We're managing this money for other people, and we're just trying to make money. And the German government has done something that we happen to approve of, but that's not why we're doing this. And I think that's maybe another danger that I wish I had mentioned earlier when you asked about the dangers, is if people start deciding, what the world needs, investors do, particularly with other people's money, does that corrupt the interests of a democratic elected government to decide what we want to promote, what we want to subsidize?
Who elected Larry Fink? Is that the? I just want to get to. We have another hand up there, so let's get questions in the very few minutes remaining, and then one more hand up there.
My question goes back to a remark that gentleman was talking about, the interests of the millennials, the young people, and things like this. And then there was an implied disparagement of sort of the legacy people in this. And I just want to say that I came of age in the 60s. And anyone who came of age during that period of time understands that my young generation at that time took on enormous social, economic, and environmental issues, which have laid the groundwork for progress that we've made over 40 or 50 years. So first question is, why are young people today special or different than those of us who were young in the 60s? And a second part of the question, out of respect to my parents' generation, I would ask if the Marshall Plan is an example of massive impact investing by the United States for the recovery of Europe after World War II. So those are my two questions. Thank you.
In the interest of time, we may just go for the first one. Jim, just what's so great about millennials?
First of all, I think there are a lot of really great people in the legacy generation. I happen to be one of them, but in my experience, I find that the newer generations are more wired to be looking at a correlation between, how they invest their, make their investments, or how they invest their time, and what the impact or benefits are to society. I think there's a greater number that are more interested in linking the two, and that was the point that I was making.
And can I just say, we did a study to actually compare millennials to other generations, and I totally agree with you. All generations are great, especially the greatest generation is really great. We found that millennials just have a different approach to it in terms of saying that they really believe in a consistency across sort of all their lives. Perhaps this is because they've grown up in an era where privacy is dead and there's full transparency. But millennials, compared to other generations, were 3 times more likely to want to choose a job, a career, a company, an employer because of sustainability. They were twice as likely to check the product packaging of any product that they were going to buy to see whether there was sustainable food chain in it. And the big difference is they then carry that over to their investment behavior, and they were twice as likely to think about social issues in investing and twice as likely to divest from stocks if they didn't agree with them. So they were much more about, I have one wallet and I'm not going to idiosyncratically, have like the different sections of my billfold compete. The good news, just to your fiduciary question, because I think that is the heart of the matter for a serious investor community, is we are, again, look, in our role, right, our role is not philanthropic advisors. Our role as Morgan Stanley is not to say how you could divert from profit towards impact. Our role is to say, can you do it in ways that are consistent with your fiduciary duty? I think the recent change in guidance from the Labor Department about 2 years ago that basically said specifically to fiduciaries managing pension funds, where you believe, with your best analysis, that environment and social governance considerations can be important information to help you be aware of risks or aware of opportunities, you can and probably should think about how you want to apply those to best manage your portfolio. So from our perspective, I think, especially if you think about something like the Sustainability Accounting Standards Board, the whole point of this is to say, I've never met a sophisticated investor who says, I don't want more data to consider. I, as an investor, will then decide what data I think matters, but I've never seen a smart investor saying, I want to blinker myself from data that could be material to valuation in my fiduciary duty.
We are almost out of time. Richard, I'm going to give you a final word. I just want to apologise to the gentleman there because I've managed the time terribly. You'll have a chance to ask questions outside the session. Richard, final
In terms
word.
of millennials and what they're thinking, my training is not as a psychiatrist, it's as an economist. And what I'm interested in is, we all want the same things here. It's what's going to be the most efficient tool to make it work. And it's a theoretical and empirical question that I think has only begun to be explored.